Good evening, everyone. My name is Rahan Amarhom. So, now let's continue the report about financial statement analysis. Wherein last meeting, we stopped here sa quick or acid test ratio. So, now we'll be talking about the asset management ratios. So, this asset management ratios measure how effectively a company uses and manage its assets to generate sales. So these ratios help determine whether the company has too many assets or too few assets. So what are these ratios? These are the inventory turnover ratio, the sales day sales outstanding, fixed assets turnover ratio, and lastly the total assets turnover ratio. So let's first talk about the inventory turnover ratio. So this ratio measures how many times the inventory is sold and replaced during the year. So to get the inventory turnover ratio, our formula for this is equal to sales over inventory. So the in the example wherein our sales is 3,000 and our inventory is 615. So 3,000 divided by 615, that is 4.9 times, which is our inventory turnover. So that means the inventory turnover is ratio is 4.9 times, while the industry average is 10.9 times. So this means the company is holding uh, too much inventory compared to the competitors. So it means excess inventory is not productive and may include obsolete goods. So therefore, a low turnover ratio can indicate poor inventory management. Now, let's talk about the days sales outstanding or the DSO. So this days sales outstanding measures how long it takes for customers to pay after making a purchase on credit. So take note of the on purchase on credit. So this means our formula will involve receivables divided by the average sales per day. So out of 365 days. So using the given values, our figures here is receivables is equal to 375, while our annual sales is 3,000, which if going to divide it, our DSO is approximately 46 days. So, which means there's a difference between, there's a ten days difference dun sa industry average. So, it only means that the customers are paying late since the company's credit policy requires payment within 30 days dapat. So, a 46-day collection period suggests inefficient collection of receivables. So, late collections can reduce the availability of the cash of the company and may increase the risk of bad debts. Now, our third ratio is the fixed asset turnover ratio. So, this ratio measures how efficiently the company uses its plant and equipment to generate sales. So, to get the ratio, this is equal to sales divided by net fixed asset. So, given the figures, our sales is 3,000 and then our net fixed asset is 1,000, which will result into a fixed assets turnover ratio of 3 times, which is actually slightly above the industry average of 2.8 times. So this indicates that the company is efficiently utilizing its fixed assets. However, take note that the comparisons can sometimes be misleading because older assets appear lower in value due to depreciation. But on bottom line, the company uses the fixed assets efficiently. Now, our next ratio is, which is our last ratio for under asset management ratio, is total asset turnover ratio. Now, this ratio measures how effectively the company uses all of its asset to generate sales. So, our formula will be sales divided by total assets. So, using the values, our sales is 3,000 and our total assets is 2,000, which will give you a result of 1.5 times compared to the industry average of 1.8 times. So this only indicates that the company is not generating enough sales relative to its total assets, which the problem mainly comes from inefficient management of the inventories and receivables. So that's the ratios under the asset management ratio, which will be now proceeding. That is debt management ratios. So when I say debt management ratios, this evaluate how much the company uses or how much debt the company uses and whether it can meet its financial obligations. So the rule, uh, as we can recall, the rule of I mean the direct relationship between debt and risk, wherein um, using that can increase returns, but it also increases financial risk. So there's a direct relationship between the debt and the risk. So the higher the debt, or the higher the return, the higher the financial risk. Now, what is the effect of the financial leverage? So, the leverage can magnify the returns during good economic conditions, while the losses during, it can also magnify losses during bad economic conditions. So, for example, the report compares two companies wherein the firm U, which has no debt, and then the firm L uses debt financing. So both firms have the same assets and the operating income. So under the good economic conditions, the leveraged firm earns a higher return on equity because of the debt financing because the debt financing magnifies profits. However, under bad economic condition, the leveraged firm experiences losses and may even face bankruptcy. So this shows that the debt can increase both returns and risks. So as what I've said earlier, the direct relationship of return and risk. So with so under the debt management ratio, we have this measurement wherein the debt ratio measures the percentage of assets financed by the creditors. That is, our formula would be total debt divided by total assets. So using the report, our total debt is 1,060 and our total assets is 2,000, which will give you a result of debt ratio na 53%, while yung average ng company is only 40%. So this means more than half of the company's assets are financed through debt, wherein a high debt ratio increases financial risk and may make borrowing more difficult sa company in the future. So in short, the company relies heavily on debt financing. Now, another ratio under debt management is the times interest earned, which is also known as TIE ratio. This actually measures the company's ability to pay interest expense using operating income. So the formula is equal to earnings before interest and tax divided by interest charges. So using the values, our EBIT is 283.8 and our interest charges is 88. So the tie ratio would be 3.2 times while yung industry average is only 6 times. This means that the company has a relatively um, low margin of safety in paying their interest obligation. So when you say margin of safety, low margin of safety, it means a low tie ratio suggests financial weakness and difficulty in obtaining additional loans. So I guess that's the ratios under debt management. Now, why is it important um, having these financial ratios? Having these financial ratios. These financial ratios will help the company identify their strengths and weaknesses, which that will aid them in their investment decisions and lending decisions. And at the same time, it will also assist the managers in their management planning, which will detect their liquidity and solvency problem. So there are advantages and limitations, which is the pros and cons. Under pros, the financial ratios I've discussed earlier is that there will be an easy comparison with the industry averages that is useful for trend analysis. However, on the downside, the ratios may be distorted by inflation, which different accounting methods affect comparisons. So, to conclude, financial ratios are essential tools in evaluating a company's financial health, or in sa liquidity ratio. This will measure the ability to pay short-term obligations. Sa asset management ratio naman will evaluate how efficiently assets are used. And lastly, yung debt management ratio will assess financial risk and the company's ability to handle debt. So, based on the analysis, yung mga given examples kanina, the company has weaknesses in the inventory management. May weakness din siya sa receivables collection and at the same time sa debt management din. However, the company performs reasonably well in utilizing its fixed assets. So therefore, management should improve collection policies, reduce excess inventory, and carefully manage debt to improve financial performance. So I think that's all. Thank you. Which that will end. I mean, thank you, and that ends my report.